Welcome to Conversations with Ken, a podcast where we discuss relevant topics in investing. I'm Ken Crawford, Senior Portfolio Manager with Argent Capital Management. Hello, this is Ken Crawford, Argent Capital Management, with another episode in our podcasts. Today I have with me Jed Ellerbroeck. Jed?
Hey, good afternoon.
Jed, for those of you who don't remember, is a senior analyst at Argent Capital. And what I thought we would do this podcast is to talk about at least preliminary results in the third quarter. Some volatility, Jed?
Yeah, definitely. Yeah, it's been a tough quarter. More stocks going down on earnings than going up.
So some of the sectors that I thought we could touch on, financials, for listeners who don't know, they generally report early, especially banks. What did we see there, Jed?
A continuation of recent trends, I think. If you tick through the major metrics, net interest margin, a bank's revenue, a primary source of revenue, has been increasing largely due to the Fed's actions. Rates have risen by almost 400 basis points now year to date. That means additional money for the banks, and it's largely dropping to the bottom line. And that's because credit remains favorable overall. Business losses are very low.
Loan growth? Loan
growth is decent. Yeah, it's pretty good. It's really not indicative of a recession, in a traditional recession. So, credit for business is good. Credit for higher income consumers is good. You're seeing a fair amount of deterioration in subprime credit, but the banks don't do a whole lot of that. Most of that lending is done by credit card lenders and by kind of non-bank financials.
And one of the topics that was top of mind was deposit betas. Can you tell the listeners what that is and what the banks were saying?
Yes, sure. Deposit beta means how much is the bank having to increase its deposit rates for consumers and businesses in relation to how much the Fed raises interest rates. So year to date, the Fed has raised interest rates, like I said, almost 400 basis points. If a bank has had to increase its deposit rates by 100 basis points, which is 1%, that means their deposit beta is 25%, 100 divided by 400. Those deposit betas are increasing as the quarters go by. And that's because deposits are generally leaving the banking system. You hear sometimes about M2, a money supply metric, declining. That's what that is expressing. And so banks are getting, not desperate, but more interested in deposits as this year has gone by. And I think you're going to see that continue the next couple quarters. Deposit betas a couple quarters ago were 10%, 20%. Now they're in the 20s to 30s. And I think some banks are expecting that to get as high as maybe 50% over the next couple quarters.
So with higher interest rates, we consumers or depositors to banks are surfing around and trying to get the best return on our money.
Yeah, I mean, just a conversation last week amongst us analysts was, where are you putting a couple $1,000s of your own personal money if you've got it sitting in your checking account? I think everybody just kind of left it in their checking account the last couple of years because rates were zero, and you could spend a lot of effort trying to find like an online savings account, but it would only get you an extra 20 or 30 basis points. Well, today, it'll get you an extra 250 basis points.
2.5%. So that would be a good thing to do, or you could just give it to Argent Capital if you had money sitting around.
An even better choice, yeah.
Okay. Technology, a few stocks that showed, as you talked about, some volatility. What stuck out with you, either stocks or trends or whatever?
Yeah, I think that there's a lot of fast-growing technology companies that we all read about in the financial press. Most of those companies are seeing their revenue growth decelerate, and even more of them are seeing their margin decline. And that's because those businesses largely had an unexpected boom after Corona.
Right. COVID.
And after COVID. And so, that extra revenue flowed to the bottom line initially. And then I think management teams decided, for the most part, to start investing more aggressively and trying to grow faster. And that worked. But now, compensation for employees, incentive compensation, it's all risen, fairly dramatically. The wage inflation has hit hard. And also there's inflation in all kinds of technology goods and products, servers, routers, all those things. So we are seeing margins decline across most technology companies today. And I would say at this point, it's still spreading.
And one of the areas that had been a source of growth was social media, digital advertising, and there the results were not so great. So what was going on there?
Yeah, we talked about earlier how loan growth was not doing things that it typically does when a recession hits. Advertising, meanwhile, is doing the things that it typically does when a recession hits. Advertising spending is an outright decline. And that's across basically all forms of advertising, even the faster growing, newer, digital advertising. Google grew their advertising revenue, I think, by 4% in the quarter, year over year. Snap was down. Meta was, I think, down a little bit. So it's a much more challenging environment. I mean, 1 year ago, those companies were growing their revenue 20, 30, 40%.
Right. And Meta in particular, after a quarter that investors weren't too happy with, got hit considerably afterwards. What did Mark Zuckerberg, say that investors disliked so much?
Zuckerberg said that the company is going to keep investing very aggressively to expand their services and to kind of double down on this metaverse product offering that they're trying to get in customers' hands.
So investors worry a bit about digital advertising and social media, and then Zuckerberg says, and we're going to spend lots and lots and lots of money.
Yeah. 2 years ago, investors were pretty excited to hear that these companies were going to invest aggressively to grow. Today, if you say that, investors aren't so excited about it. The environment has changed quite a bit.
Right, and you see that in stock prices, especially after the companies report the next day. So another sector that you thought was particularly noteworthy, industrials, what made that stick out to you?
Supply constraints still exist in industrials. There are fewer and fewer areas of our lives and businesses generally where there are still supply constraints. But I think one of the biggest ones is industrial goods, generally speaking. Most industrial equipment companies are still unable to fully meet consumer demand, which has given them pricing power that they aren't used to having and has allowed for margin expansion.
And what are you seeing with units?
The flip side to being able to raise your prices double digits is you lose the marginal buyer. And so, a company like, I think Caterpillar reported their results last week. We all see their products driving around construction sites in our normal lives. Their average product price increase was 15% year over year. That's an incredible number. That's 4 years worth or 5 years worth in normal times. And their volumes were down, even though there's plenty of demand for construction equipment these days. They just can't meet demand. Some demand has dropped off because they've raised price so much. And Caterpillar is winning in this scenario. Their earnings are going up.
So that's a brief look at third quarter earnings so far. Jed Ellerbroeck, Senior Analyst at Argent Capital, I want to thank you. Thank you all for listening. If you have any questions, please contact us, and we'll talk again soon. Thank you for listening to Conversations with Ken. For now, stay safe, stay well, and thank you for investing your time with us.
This podcast represents opinions from portfolio managers of Argent Capital Management, LLC, a registered investment advisor, and reflect the portfolio manager's judgment on the date of this podcast and are subject to change. The podcast is meant for informational purposes only, is not intended to serve as a recommendation to buy or sell any security. It is also not a research report and is not intended to serve as a basis for any investment decision. All investments involve risk, and the past performance of a security or financial product does not guarantee future results or returns. Investors should consider their investment objectives and risk carefully before investing.